Fixed Income Portfolio Management, Part 1. In Business 591, you learned about fixed income security pricing and how prices relate to changes in interest rates. Using time value of money concepts, you also learned about how maturity, coupon rates, and yield to maturity impact bond prices. Fixed income portfolio management expands on these concepts. By the end of this module, parts 1 and 2, you should be able to describe fixed income securities, including issuers, common features, risk and bond quality ratings, explain yield spreads and how they change, and the yield curve and how to interpret its underlying shapes. Assess a bond's price sensitivity to interest rate changes. Calculate duration, modify duration, and convexity, and discuss passive and active strategy for fixed income portfolio management. There are many different types of fixed income securities. Bonds are normally grouped for financial reporting purposes. The identifiable groups are also useful for comparing and contrasting yields and yield spreads. Some common groupings are by issuer, such as the U.S. federal government, U.S. federal agencies, state and local municipalities, corporations, and international issuers. By cash flow characteristics, coupon bonds, zero coupon bonds, and U.S. Treasury strips. By interest rate characteristics, floating rates or variable rate bonds. Treasury inflation protected securities referred to as TIPS. Interest only mortgage securities. By maturity, short term, for example 1 to 3 years, intermediate 3 to 10 years, long term greater than 10 years. By credit rating or collateral. High yield junk, investment grade bonds, debentures, which are non-collateralized, equipment trust certificates, mortgage-backed bonds. Other ways to group bonds include by industry, the utility bonds, mortgage-backed bonds from the real estate industry, by country, or by currency, foreign bonds, bonds that are issued in countries in that currency, euro bonds, issued outside the country but in the home country's currency, hybrid and innovative bonds, bonds with convertible to equity options, puttable bonds, pay-in-kind bonds, reverse floaters, index bonds, i.e. interest payment is linked to some underlying commodity, disaster bonds. Fixed income investing is not risk-free. Like equities, fixed income securities face both systematic and specific company risk. The systematic risks include interest rate risk, or changes in the underlying value due to a change in interest rates, reinvestment risk, reduced yields to maturity due to lower reinvestment rates on coupon payments, purchasing power risk, or the risk that inflation will exceed net bond returns. Security-specific risks, which are primarily an issue when purchasing individual bonds, and these include default risks, the risk that the bond issuer cannot pay the coupon, or worse, the principal. Call risks. For callable bonds, there is a risk that higher yielding bonds are called away at a price that does not compensate the bondholder for having to reinvest those funds into lower yielding instruments over a period of time. Exchange rate risk. There's a danger for holders of foreign bonds. Liquidity risk. Many corporations and municipal bonds are most liquid when initially sold. The market for the same bonds may be limited, resulting in a significant discount or haircut if forced to sell the bonds prior to maturity. The federal government is a major issuer of fixed income securities. Within the capital markets, the U.S. Treasury Department issues notes and bonds. They are denominated in amounts of $1,000 and above. The U.S. Treasury notes have a maturity of between 1 and 10 years. Outstanding U.S. Treasury bonds have a maturity between 10 and 30 years. In 2001, the federal government stopped selling new 30-year bonds, but sales were renewed in 2006 following demands by pension funds and other long-term bond holders for extended maturity securities. U.S. Treasury notes and bonds are coupon-bearing instruments, and they are usually paid semi-annually. Because these securities are the obligations of the U.S. government, they have an important advantage over other capital market instruments in that they are considered default-free and contain highly liquid features. When capital market risk rises, U.S. government bonds outperform all other debt and equity instruments because of the flight to quality. Treasury note and bond quotes are given as a percentage of par value in 30 seconds. Take a look at this Wall Street Journal quote depicted on your slide. The bid price of August 2011 5% note is 108.24. That means the note is selling at 108.24 30 seconds of par. Assuming a denomination of $1,000, the price is calculated as 1,000 times 108.24 30 seconds, or $1,000 times 108.75%, which equals $1,087.50. When you purchase a fixed income security between coupon dates, you also have to include the amount of the accrued interest owed to the holder. That means that the total price of the bond is equal to the price of the bond plus accrued interest. Let's work a sample problem to understand how accrued interest is calculated. Question: what is the total price you would pay for the 5% August 2011 Treasury bond if the price of the bond is $1,087.50 and 50 days have elapsed since the last coupon payment? You already calculated the note's price of $1,087.50. So now you need to know the accrued interest. First of all, let's determine the semi-annual coupon payment. The August 2011 note offers a 5% coupon. That coupon is quoted on an annual basis. Assuming that the note's denomination is $1,000, the annual coupon is 1,000 times 5%, which equals $50 for the full year. That means the semi-annual coupon is half of $50, or $25. Next, you want to calculate what percentage of the 6-month period the note was held by the prior owner. In this example, you are given that 50 days have elapsed since the last payment. That means that the prior owner is entitled to 50 divided by 182, or 27.5% of that next semi-annual payment. Doing the math, you quickly find that the prior owner is entitled to $6.87. Assuming or adding that to the note's price gives you a total cost of $1,094.37. Agencies of the federal government also issue fixed income securities. These agencies include the Government National Mortgage Association, or Ginnie Mae, the Federal National Mortgage Association, or Fannie Mae, and the Federal Home Loan Mortgage Corporation, FHLMC. Agency issues are denominated in amounts of $1,000 and above, and their maturities range from 1 to 30 years. These securities are coupon-bearing instruments, and they usually are paid semi-annually. Although they're considered to have low risk, it is important to note that, other than Ginnie Mae, agency debt is not a full faith and credit obligation of the federal government. There is only a moral obligation, not a legal obligation, to support the payment if the agency defaults. While this aspect was tested by the bond crisis of 2008, the government continued to make good on agency bond payments. U.S. corporations are also major issuers of fixed income paper. Bonds of corporations have maturities ranging from 1 to 30 years, although some issues have been for even longer periods. Unlike U.S. government bonds, the price of corporate bonds are quoted as a percentage of par, not in 30 seconds. These securities are usually coupon-bearing instruments, and the payments are generally made on an annual or semi-annual basis. The characteristics, risks, and types of corporate securities vary significantly among corporate fixed income securities. For example, the bond of one corporation may have very different restrictive covenants, call provisions, or conversion features than that of another. Risks of default vary, as do liquidity concerns. Some corporate bond markets are thin, making it difficult to sell securities without taking a haircut for the trade, i.e., sell at a discount to the bond's actual price. Also, as you already learned earlier in this module, there are many different types of bonds, different backings, for example, secured versus unsecured bonds, and different registrations, for example, registered versus bearer bonds. Companies such as Moody's, Standard & Poor's, Duff & Phelps, and Fitch provide the financial community with credit analysis on bond issues. Their analytical work helps investors to understand the default risk of the corporation, including issuing the paper. The factors in the rating matrix for each rating company are proprietary. However, common criteria include company cash flow stability, profitability, competitive environment, economic and sector activity, debt coverage and leverage, ratio and trend analysis of key data, and management performance. The ratings agencies were subject to harsh review following failures to accurately judge the danger of credit default swaps and other derivative securities in the mid-2000s. Since then, the agencies have been forced to review their standards to ensure improved quality assessment. The table on this slide shows the credit rating matrix for Moody's, Standard & Poor's, and Duff & Phelps. It is important to note that a company's bond ratings directly impacts the coupon rate the company has to offer in order for investors to hold the debt. You will examine this in more detail later in the lesson. Question: how does the financial community deal with higher default risk? What do investors require of companies with higher risk before they're willing to purchase the company security? 3 ways of dealing with default risk are: increase the cost of issuing the debt, placing restrictions on the company, and requiring sinking fund provisions. Let's take a look at each. The cost of issuing debt. The interest demanded by the financial community is perhaps the most visible way of dealing with default risk. The additional cost of interest due to higher risk is a function of the risk-free rate and credit rating yield spreads. We'll cover this on the next chart. Bond indentures. Bondholders may place restrictions on the company. These restrictions including prohibition against issuing additional debt, limiting dividend payments, requiring specific collateral, and subordination clauses. Sinking fund provisions. These are requirements for the company to set aside X dollars a year that will be used to repay the principal at time of maturity. The yield spread describes the differences in rating rates that one bond grouping or credit rating class offers compared to another. Look at the Citigroup yield book graphic on this chart for a moment. It depicts the yield spread between U.S. corporate bonds rated B with those BB. The y-axis of the chart shows the interest rate spread in terms of basis points, i.e. 100 basis points equals 1%. Knowing that a 60 basis point spread means 0.6% of 1% or 0.006. Yield spreads between higher quality and lower quality issues tends to widen during recessions, as there's that flight to quality that we spoke of a few slides ago. And that yield spread tends to shrink during times of expansion when company prospects improve. Here's a good example of how the yield spread can expand during a severe test of market quality. Relative to 5-year U.S. Treasuries, the 5-year investment-grade corporate bond rose from less than 100 basis points spread to nearly 700 basis points, i.e. 7%, while junk bonds rose to a 20 percentage point spread. While these were both extreme periods, this slide highlights 1. The U.S. Treasury status as the market's safety net, and 2. How quickly the market will adjust interest rates relative to credit quality. Earlier in the lesson, you learned about bond credit ratings. If you recall the credit rating matrix, you will remember that bonds are analyzed to discover their probability of default. Investment-grade bonds were considered high quality, while speculative bonds had much higher default risk. For that reason, many bond funds and pension funds do not allow bonds to be held if they fall below investment grade. Let's examine what happens to the price of a bond when the default risk increases, as implied by a credit downgrade. Question: what happens to the price of a company's $100,000 4% coupon bond that matures in 5 years if the company's credit rating is downgraded from BBB to BB, from the lowest investment grade rating to the highest junk rating? In solving this problem, we will use the Reuters corporate bond spread spreadsheet. Note that the spreads are shown in terms of basis points, and as discussed earlier in the lesson, 100 basis points equals 1%. And please note that this is an example of yield spreads. It's dynamic and it continually changes. In the first part of the course, you learned that the required rate of return for a security is equal to the risk-free rate plus a premium for the level of risk assumed. Using this bond spread matrix, you would start with the 3.3% for a 5-year bond. The BBB rated before tax cost of debt would equal 3.3 plus 0.92 or 4.22. The 3.30 for the Treasury plus the risk premium for the BBB of 0.92. The 92 basis points that are added to the risk-free rate is that risk premium. The market yield required on the BB rated debt is 3.30, but in this case 360 basis points, which equals 6.90. So based on this example, the implication of being downgraded from BBB rated to BB rated is an additional 2.68%. That's the additional risk premium for going down the scale or holding a riskier bond. Using the financial calculator and the data provided, the valuations for both the BBB rated and the BB rated bond can be found. You see that the downgrade decreased the value of the $100,000 4% bond by $10,951, or over 11%. That is why it is very important to monitor the credit quality of bonds held in a portfolio. The yield curve depicts the structure of spot rates in relation to time to maturity. Generally, but not always, rates are held for longer maturities. Rates are higher for longer maturities. Three theories used to explain the term structure of interest rates are liquidity preference, i.e. investors prefer liquidity, therefore they demand a higher interest rate to hold longer term assets. The expectations theory, which says that yields at different maturities reflect market expectations about future rates. And segmentation theory. The yields are a function of supply and demand for the various maturities, whether we're looking at a 10-year, a 20-year, a 30-year security. As just discussed, rates are generally higher for longer maturities. When this occurs, the yield curve is said to be normal. When short rates are higher than longer rates, in other words, rates in 1, 2, 5 years compared to the 20 or 30 are higher than those longer rates, the yield curve is referred to as inverted. Sometimes the level of short and long-term rates are about equal. When this occurs, the curve is said to be flat. The normal curve is upward sloping. Yields are higher for longer maturities. This curve is prevalent during periods of expansion and economic prosperity. A steep curve often precedes an economic upturn. A higher long-term rate signals an expectation for future inflationary pressures. So you could see how that would work in an economic expansion. The market assumes in this period of growth that there will be future inflationary pressures. The inverted curve is downward sloping. This pattern has occurred 8 times in the last 50 years. In 6 of those occurrences, the U.S. went into a recession. 6 out of 8 times. The lower long-term rates signal lower inflationary expectation. And you would see how that works if you assume that everything's going to slow down going forward. The flat yield curve depicts a pattern where rates across the time spectrum are about the same. When a flat yield curve develops from a normal curve, it is signaling a possible economic slowdown. So you're moving from the normal. This is starting to move flat, thinking we might be going into an inverted yield curve. When a flat yield curve develops from an inverted yield curve, it signals the expectations, at least by the market, of an economic pickup. So a few final thoughts. Although there are mixed results, the slope of the yield curve has been a leading indicator of future economic activity. Also note that all shifts in yield curves are not parallel. Therefore, some segments of the curve might exhibit a hump. In this lesson, you learned about the characteristics, risks, credit ratings, and types of bonds. Credit ratings and how changes in rates can impact bond pricing, and the yield curve, and the differences in informational content of those yield curves.